Hello and welcome back this week, everyone. I'm David from AEI.ag, talking about the chart of the week, where sit down and share just a few thoughts and a few ideas of the content we've been writing and sharing and producing on the AEI website. This week, we're thinking about interest expense. It's gone up quite a bit. It's up 35% since 2021 at the $30 billion mark. In inflation adjusted terms, it's like a lot of things in the economy, the highest we've seen in several decades, but also nowhere near the 60 billion, again, adjusted for inflation, high that we saw back in the early 1980s. One of the things I think is really important to think about is a lot of attention, of course, has been paid to interest rates, and that's, of course, the cost of borrowing the money. But the other factor that influences interest expense is the quantity of debt being used. So there's the price and there's the quantity of debt. And so we took a step back and we said, okay, how much of the annual change in interest expense can be chalked up to changes in debt levels, and how much can be chalked up to changes in interest rates? And so this is where we are with this chart of the week. And as you can see in blue are changes in debt levels, and that's been pretty consistently high year over year, adding between half a billion and $1 billion a year in expense. And you can actually see the last 4 years that's been higher than what we saw in the years prior. These are nominal changes, so we aren't adjusting for inflation here. The orange bars represent the changes that come from interest rates, and as you can see, really big changes that occurred in 2022 and 2023. The effective interest rates across all farms is so far for 2024 expected to be unchanged, but that of course would probably be revised and updated in the future. But the idea here is there's a lot of change in a very short period of time, and that came out of interest rates. But there's sort of this back and forth. Interest rates trended lower for most of the last 15 years, but debt levels have continually sort of clipped away at a very small but steady rate. And so one of the charts that we had, and we looked at a couple different ways, is this is the cumulative change in farm interest expense. So if you think about how the expense changed over the last 5 years, and you added up those negatives and those positives, you can see that across time, there's a really big difference. The majority, about 65% of higher debt levels today than just 5 years ago, was because of debt levels. The other 35%, of course, came from interest rates, higher interest rates. A really big change in a short period of time coming from those interest rates. But this cumulative effect really gives us an idea of how this has changed, over this time period. If you zoomed out just a little bit more, you can see that over the last 15 years, the cumulative impact has really been these debt levels. In fact, interest rates today are actually on an effective basis. So this is all the debt that's issued, and of course that's benefiting from debts that was locked in at lower rates a few years ago. But we have a lower effective interest rate across all debt in the farm economy today than where we did back in 2010. So again, the upturn over the last 15 years has been largely driven because of, almost exclusively driven because of debt levels. Of course, the implications, of course, and when you think about this, is if interest expense is a concern, if we're thinking about it, we really need to think about the two sources, the rate and the quantity used. And we've talked about this in other articles, talking about the ag debt cycle and sort of thinking about if interest rates are priced at a higher level, would we be using more or less debt throughout the farm economy? That's all we have for this week. Until next time, stay curious.